Good evening. Welcome to Fitzgerald Financial Town Bank Mortgage 101 on grants and FHA, VA, USDA, part two of the series. We also have with us Sean Higgins, who is the Senior Vice President at United One, and he's going to do his presentation on everything you need to know about credit scoring and your credit score, how to increase it, how to manage your credit score to the best of your ability to maximize your score so you could purchase not only a mortgage, but you could get great credit card interest rates and so forth. So we've been doing these events for a period of about 16 years. 16, 17 years, and we do them on a constant basis. And it's part of our literacy training and giving back to, everybody that's interested and everybody trying to purchase a home, because conclusion is that the way you start building wealth is with a home. And the only way that we see that you could get properly educated, my apologies, is to ensure that you're pre-qualified and that you go through the process, but most important, that you're getting accurate information. One of the, we hear it all the time about people getting the horror stories of the information that people receive. So there's a lot of myths that will be debunked tonight. So by the end of the evening, you will have a working knowledge of not only how to get pre-qualified, but a lot of the programs that's available to you and everything that you need to realize about your credit. And first and foremost, before I introduce Sean Higgins is not a credit repair person, okay? And he'll explain that himself, but there's a place for what he does, and he works with lenders, and he will help you through us by increasing your score, getting rid of debt, but you're involved in the process too. So it's not some place where you're going to some shyster that you're paying thousands of dollars to take care of your credit, when you could just take care of your credit yourself and apply the rest of the money to either a down payment or to your bank account where it belongs. So without further ado, Sean Higgins.
Thanks, Shervin. Great to see you as always. Looking forward to tonight's presentation. As Shervin has said, my name is Sean Higgins. I'm with United One Resources. I'm based in Pennsylvania. I've been doing this for 31 years now, and last 16 or 17, as Shervin said, side by side with Shervin. And Shervin was great to point out at the very beginning that we are not credit repair. There are credit repair places out there that will more or less take your money from you and make promises and really not deliver the results. All the items that we're going to talk about tonight, you can actually do on your own with the guidance of a professional. So the thing that I like to establish right up front is you get a lot of questions. Where's the best place to start? And it's a great question to ask. And the answer is you start with a mortgage professional like Shervin. They'll pull the credit report. They'll engage the services of a company like ours. And actually on Shervin's side, he's very well versed in the process himself. So we work very good together. We provide the credit reports to the lenders, and with our simulator tools that we have, we're able to show what kind of improvement to the credit score is available and provide a plan, and hopefully leading a path to home ownership. So I have a presentation that I'm going to put up on the screen here, and I'm going to go through a lot of information on credit scores, how they're calculated, how to improve them, some of the information that exists in credit scoring that's made its way into the mainstream media, and people are actually becoming more and more knowledgeable. So there's my contact information. If anybody has a need to get in touch with me, there it is there, or you could actually contact me through Shervin as well. Okay, so let's start the process. Okay, so credit scoring. What is credit scoring? So credit scoring really is one of the most important factors when you apply for a mortgage. It's going to assign a score to your credit file. And based on that credit score, it's going to be a measure of the risk of default of the consumer paying their mortgage. The score that we use in mortgage lending is FICO score version 8. A couple of things to remember: there are 3 national credit repositories. There's TransUnion, there's Experian, and there's Equifax. And the credit score is calculated based on the information that's in the file right then and there. So you'll hear me say throughout these presentations that the credit score is almost like a stopwatch at the end of a race. The credit files get presented, the request for the credit files goes out, the credit reports get presented, and then a score is appended. Sometimes there's some information that might not be accurate, so it's really, really important that as consumers, you become aware of what's going on with your credit file. So you'll hear me use a term called credit fitness. And I really think credit fitness is a very, very important and positive factor in people's lives, because that will give you, I use that term in describing how you should become aware of what's in your credit file and work towards improving your score with some of the things that we're going to talk about tonight. Okay. So score ranges. Scores range between 300 and 850. Anything above a 700 is considered to be an excellent score. As Shervin said at the beginning, we work with lenders to provide them with credit reports, and then we also provide additional services on how to improve the scores. We usually fit in the mid fives, 100 score range, trying to improve those scores and getting people into the ranges that will allow you to get a mortgage. Now, Shervin will get into more details on the scores that you need for a mortgage, but you can see what the bands are right now. It's between 300 and 850. And I can tell you in all the years I've been doing this, I've only seen a handful of people with scores over 800. It's just really not a lot of people out there with that type of a score. Okay. So how is the score calculated? There's a couple of score factors. There's 5, and the Fair Isaac score. Fair Isaac is Fair Isaac Company. The acronym that they use for their company is FICO. And the score has a couple of different attributes that make up the score. The 2 biggest score factors are the payment history. So really, it's just plain and simple how well you pay your bills. That's the biggest factor that's assigned to the credit score. Second factor is amounts owed. So amounts owed really, as it relates to credit scoring, is going to be your revolving credit card accounts. And when your revolving credit card accounts balances to available credit start exceeding 30%, that starts to chip away at your credit score. So how well you pay your bills and how much utilization or balance to available credit you have on your revolving credit or credit cards are the 2 biggest factors of your credit score. New credit, not so much. Length of credit history, a little bit of a factor as well, and credit mix. So that adds up to 100%. And like I said, 65% of it, you could really control it by paying your bills on time and keeping your utilization low. Okay. So how does a lender actually get your credit information? It's through an inquiry. And there are 2 types of credit inquiries that are available in lending. One is a hard inquiry. And that's an inquiry, it's posted as a hard inquiry to your credit file. And that's in connection with an application for credit. So a consumer will approve the right to pull the credit report through a hard inquiry. The other type is a soft inquiry. A soft inquiry, 2 examples I could give you on soft inquiries are if you have an existing relationship with a lender for a type of credit, they probably have in their agreement with you the right to pull your credit report once a year through a soft inquiry and get a feel for what's actually happening with your credit situation. The other thing that soft inquiries are also used for is for pre-approved offers of credit. So when you come home at night and you get your mail and you'll see, for instance, a pre-approved offer from Discover or one of the credit card companies, or maybe a home equity lender, or maybe even a car loan, they're getting that through a pre-approved offer, and that's also considered to be a soft inquiry as well. Okay. So one of the most frequent questions I get is how much does an inquiry count against your credit score? People ask that question. Say, well, sometimes I'll have lenders will call me and they'll say, hey, I have someone that doesn't want their credit report pulled because they're afraid it's going to have a negative impact on their credit score. Okay. What we do see is probably 30 days after your credit report is pulled, it's through a hard inquiry, through an application, you're going to see about a 5-point decrease in your credit score. Then another frequent question is, if I'm out shopping for a particular type of asset, whether it be a car or a home or whatever, if you aggregate a lot of those credit inquiries into the tight time frame, and the two of the credit bureaus do it within 14 days, and another credit bureau does it within 30 days, they'll be considered to be one. So, for instance, if you wanted to go shopping for a car on a Saturday and you look at 5 cars and there's a lender for each of those cars associated with it, you don't have to fear that your credit score is going to get dinged by 25 points in 30 days because the scores take into consideration the fact that those types of transactions do happen that way. And when that does happen, it's also, what's the way to say it? It's just considered to be one. So the myth out there is if you pull your credit report, it's gonna really have an impact on your credit score. The truth is 30 days later, 5 points. And that's really the two things that you need to remember. Okay. Don't be afraid to have your credit report access, especially if you're in need for a loan for a home or a car, whatever it may be. So a couple of things to remember as far as keeping your FICO score high. It's paying your bills on time, keep those balances low on those on the credit cards, and quite honestly, only apply for credit when you need it. Over time, you can improve a credit score. As I said earlier, we have a simulator tool that allows us to suggest certain actions and improve a score over a certain time frame. The lender that we work with, in this case, Shervin, they actually present those plans to the consumers and have a lot of success together. Another place that you could find out what's going on with your credit report is through annualcreditreport.com. And through 2023, the government, which oversees this service, annualcreditreport.com, is making a copy of your credit report available to the consumer free every week through the remainder of 2023. It's one of the last remnants of the COVID period. It's a good idea to get access to your credit report. It's a free service. It doesn't have a credit score, but you can see what's actually in your credit report, and you can see who's made hard inquiries and who's made soft inquiries on your credit file. That's one of the two things I like to talk about when I talk about credit fitness. Annualcreditreport.com. Pretty simple site. You will have some challenge questions to make sure that it is in fact you, that only the consumer should know. Okay. What actually is going to have a negative impact on your score? It's anything that's currently late. High balances on unsecured debt, credit cards, or revolving debt. There's a couple of different ways to use that. If you have any public record information that's out there, like a bankruptcy, judgments and liens, that's obviously going to have an impact on your score. And quite honestly, if you don't have a whole lot of information on your credit report, that will not really assist you in gaining a high credit score. Okay. So what are the 5 best ways to improve your credit score? Probably one of the most negative things that could happen to someone is if a collection agency places a collection account trade line on your credit report. So trade lines are all the components of the credit report. Each account that you have is considered to be a trade line. What we've found is with these collection agencies, there are going to be situations where they're willing to work with you to have those removed from the credit file. I always advise people, if you have a collection account on your credit report and you want to pay it, make good on it, you should always offer to make the payment in exchange for them deleting the trade line from your credit report. That's worth about 50 or 60 points to your credit score. If you have a one-time late or something like that, we see people that have, for instance, a one-time late on a credit card, and once again, the negative of that is in excess of 50 points. We found that if you go back to the company that's reporting that owns your account and is reporting your late, and if you've had a pretty good payment history with them, there's a good chance that they're just going to go ahead and remove that late if you call and let them know that this was an oversight. It's not indicative of how I pay my bills. there's a lot of sympathy out there for that. That's always something that we recommend too as well. Keep those revolving balances below 20%. Very, very positive impact on your credit score. And there's something else that we see a lot of is with student loans. If someone has a student loan that's in deferment, that's a right, and that's something that you should take advantage of if you can and you need it. But you have to also make sure that your student loan servicer is reporting properly to the credit reporting agencies. There's a lot of times we see student loan balances with late payment status, and when we talk to the loan officer will talk to the consumer, they'll say, well, that's in deferment. Well, it's not being reported properly. That can be worked out, but think about credit fitness. If you're looking at your credit report and doing the things you need to do to get your financial affairs in shape, you'll be aware of that in advance. Last item is installment loans. Installment loans are probably like, say, for instance, a car payment. And if you have a predictable payment every month that you're obligated to pay, and you decide that you want to try to pay that off a little sooner, I wouldn't recommend doing that because that's probably not going to have any kind of an impact on your credit score. And as Shervin will tell you a little bit later, there's better use for those funds. So really what it comes down to is, collection agencies, try to get them to delete for payment. If you have a one-time late on a credit card, you've got a long relationship with them and you've always made your payments, they're more than likely going to remove that late if you ask them for it. One-time courtesy removal. Keep those revolving credit balances below 20%. Check student loans to make sure that if they are in deferment, they are being reported properly. And really don't spend a lot of your good funds on paying off an installment loan any earlier. It just doesn't make a lot of sense. Okay. One of my favorite topics, Credit Karma. There's over 100 million people in the United States have a Credit Karma account. And that's something else that I think has a lot to do with great credit fitness. Credit Karma is wonderful. I have the app on my phone and I use it to track balances and to keep an eye on the score. There's differences though. The credit score that we use in mortgage and the credit score that we use that's being used by Credit Karma are two different scores. The ranges are the same. However, the credit bureaus, the credit repositories aren't the same. In the case of mortgage, they use all three repositories. In the case of Credit Karma, they don't use Experian. The score factors are a little different. You can see them right there on the screen. And then they will consider in a Credit Karma score your rent or your utility bills. However, on FICO version 8, which we use in mortgage lending, they don't. The big thing to remember about this is there's about a 30-point difference. So your Credit Karma score is going to be 30 points higher versus the FICO score. And that could create a little bit of confusion when someone's making a mortgage application. However, I'm very confident that Shervin in particular and his team, they're well-versed in these differences, and they can explain that and educate the consumer in the process so that they understand what's going on. Okay? A couple other quick hits on some items on the credit reports that make its way into everybody's daily life. They're reported on the news. They've been pretty popular lately. Experian Boost, they advertise a lot on TV. And Experian Boost, really, there's two things to remember with that. It will help you build a credit file. However, it's not going to improve your mortgage score. So Experian Boost, it's great if you're just starting out and you want to start maybe getting a cell phone bill or utility account, getting enough credit on your credit file to be able to apply and successfully get those kind of accounts. Experian Boost is the proper target. But for the mortgage world, Experian Boost is no help at all. And probably sometimes it could cause a little bit of an issue. Okay. Rental information in mortgage lending. It's coming up on 2 years now. Fannie Mae said that they were going to start considering rental information in the mortgage decision. Rental information has always been a very important part of the mortgage underwriting process. However, it's not going to have an impact on the score. So there was some misinformation that was presented about rentals having a positive impact on the score. It's not, but it's a very important process. And I just like to make sure I clear that up and everybody understands that. Next item is one of the biggest things that I've ever seen happen in credit reporting as it relates to the reporting of collections. So one of the big stumbling blocks for consumers in the past was if someone had previously had a medical collection, they paid it, and the collection agency, for some reason, decided that they just weren't going to remove it. That's, as I said before, a collection, 50, 60 points to a credit score. So what happened last year is the credit bureaus decided that they were no longer going to report paid collections. That's a godsend because, that trade line for the medical collection and even the paid ones really, in my opinion, did not belong on a consumer's credit report. Okay. So that's gone. So paid collections are gone. The other thing that they did two other things. They said, effective last July 1st, they're going to increase the time to report a medical collection on a consumer's credit report from 6 months to a year. Gives people a chance to unwind any issues that may exist that are causing that collection account to get there. And then the other big item was the beginning of this year, anybody that had a medical collection account, the balance had to be at least $500 to make its way on the credit report. It just didn't make a lot of sense to have that on a credit report for an $87 dentist bill or something like that. So these are wonderful things. You got to remember, though, a couple of things, which is they have to be paid to be removed. They're going to give you an extra 6 months to try to figure out how to get these paid and moved along so that they're not going to be on the credit report maybe when they shouldn't be. And they have to be at least a $500 balance to make its way on the credit report for those other types. As I said earlier, there's 3 credit reporting agencies, Experian, Equifax, and TransUnion. That's how to get in touch with them. Annualcreditreport.com, we talked about. That's one of the 2 great tools for credit fitness. The other one is Credit Karma. And then the last item is opt-out pre-screen. I've been talking to a lot of people about this for about the last year or so. This makes a lot of sense to me. Opt-out pre-screen allows the consumer to go online and opt out of those pre-approved offers of credit that come in the mail. And because quite honestly, pre-approved offers of credit are the number one reason that we see people coming to us or coming through our lenders and saying, I've had identity fraud happen in my life. How do I get this straightened out? And it's because your mail is sitting there. Anybody could open your mailbox, pull that information out, and they go ahead and they apply for credit in your name. So opt-out pre-screen will stop them. And then also in the mortgage process, there's another issue out there that exists. It's called trigger leads, and opt-out pre-screen will stop the trigger leads as well. So I appreciate the opportunity to speak to all of you tonight. As Shervin said, we want to see if we can reach some people and turn them into homeowners. And I really look forward to Shervin's presentation, and I appreciate being here tonight. Thank you.
Well, thank you, Sean. That was awesome as usual. Just very insightful as usual. And I tell you, folks, you should have been taking notes. We'll be back next Tuesday and the following Tuesday. So trust me, you have an opportunity to take advantage of the knowledge that Sean just bestowed upon us with regards to credit. It could just take you from below 600 or around 600 to 680, 700, etc. If you contact us, get pre-approved, and see exactly where you stand. You might be ready to go. You might be in a position where you're in excess of 640 or 620, which is what you need for a mortgage with us. So just give us a call at any time. We'll be more than happy to take care of you. So without further ado, I'm going to start my presentation. And tonight, it's on mortgage products that you could use once you're pre-approved and pre-qualified and you're looking for mortgage products. Again, I'm with Fitzgerald Financial, a division of Town Bank Mortgage. Fitzgerald Financial is part of Town Bank. Town Bank has been in the industry and has been named by Forbes magazine for as the number 9th performing bank out of maybe 5,000 in this country. We have all the products that you need, and we're just grateful to bring you this information. So we're going to start with FHA loans. And with FHA loan, it's a government loan, and it's probably your best instrument to use, particularly if you're a first-time home buyer. Down payment is as low as 3.5%. You could use a gift for the down payment. In other words, mother, father, sister, brother could give you a gift. It's less strict and more flexible when it comes to your debt to income ratio. Um, it's flexible credit qualifications and can be used towards home improvement. So, um, well, why is it more flexible than conventional? Well, conventional is Fannie Mae, Freddie Mac. And conventional, the rates on a conventional loan are about, I want to say, three-quarters of a point, in most cases, higher than a government loan. And a government loan is FHA or VA. So when folks tell you that you need 20% down, clearly you could see you don't need 20% down. And you're going to get an attractive interest rate, attractive in today's market, of course. But the flexibility that FHA offers you, particularly with low money down and where you could get monies. Now, you could also use a grant program to attach to an FHA if you qualify. But an FHA loan, we could close that loan provided that the person's qualified and is very responsive in 2 weeks. And it's not hyperbole. We at Fitzgerald Financial are known for how quickly we close loans. The next loan, next government loan, is a VA loan. Uniquely allows active duty reservists, veterans, and some surviving spouses an opportunity to purchase a home with zero down payment and zero monthly mortgage insurance. In other words, the monthly mortgage insurance is really not an insurance, it's a guarantee, it's a VA funding fee, and it's financed into the loan over the life of the loan. By the way, I think it was mentioned that I am also a veteran of the Marine Corps. So you're in good hands with a VA loan because you're talking to an expert. There's no money down required. If you served your country and you're VA eligible, there's absolutely no reason why you should not be a homeowner using VA entitlements. There's no mortgage insurance, as I just mentioned, flexible credit requirements. The debt to income ratio pushes to 50 to 55. So that gives you the flexibility where on an FHA, it's around 50 max. They usually want you to go around 45, but we could push the envelope to about 49, 50. This will push the envelope on a VA to 55 debt ratios. There's a limitation on the buyer's closing costs. In other words, the system only allows the buyer closing costs to be so high. There's some things that's exempt, and the seller on a VA loan could pay all of your closing costs, whereas on an FHA loan, the seller could only pay up to 6% towards closing. And you're not going to need that much towards closing, frankly. It's going to be closer to about 4.5% after you work out the numbers. There are no prepayment penalties. In other words, you can pay the loan off ahead of time and there's no penalty to do that. And there's a lifetime benefit that can be reused. So let's say you currently have a VA loan and you sold that house, paid off that mortgage. The next day you could apply for another mortgage under VA again. So, and now, particularly around the Beltway, you could go VA no money down up to $1 million, if you qualify. But that's where VA has gone over the years. It's just incredible. USDA. USDA loan is a guaranteed rural housing, helping borrowers achieve the American dream with zero down payment and minimum investment. There are only two no money down loans. I don't care what other entities tell you. In the industry, in the mortgage industry, there's two true no money down loans. a VA loan and a USDA loan. And a USDA loan is with 101% financing for qualified moderate income families looking to purchase single family homes. It's ideal for borrowers with little or no cash, no down payment required, and you could use a grant program for your closing costs, or the seller could pay 3% of your closing. So if you have no down payment and the seller's paying 3%, you're pretty much going in with minimal to no money necessary. Low upfront fee and low monthly mortgage insurance to be reduced based on principal balance. Just like the VA funding fee is to VA, there's a guarantee on USDA. It's not mortgage insurance, it's a guarantee that is factored in, and it's over the life of the loan. So you really don't feel the payment in your total principal, interest, taxes, and insurance. There's a flexibility with the debt to income ratio. Now, there's not a flexibility as much as the VA flexibility, but it is a flexibility. There's reasonable credit requirements. So if you're struggling with, you've got the credit, you've got the income, and you might just have to move away from the true city, because USDA loans are typically found on the outskirts, and that's why it's called rural, on the outskirts of the city. To give you an idea, if you're around the Beltway, Brandywine, Accokeek, Waldorf, Malton, La Plata, Charles County, USDA loans. Now, with that said, it's not a whole subdivision or a city or anything like that. These are where you find most of the houses. But you could identify a USDA house across the street, and on this side of the street, they're not approved. On that side of the street, it might be approved. You have to look the individual address up to ensure that it's approved. Okay, that's critical. It goes to the address of the property. So I always have do's and don'ts when I come to an end of a program that I'm discussing with you. And in this particular case, we just covered FHA, VA, and USDA. Now, these are the don'ts, the home buying don'ts. Do not change jobs, become self-employed, or quit your job. Number 2, do not buy a car, truck, or van. Number 3, do not use charge cards excessively or let your accounts fall behind. These are all home buying don'ts that you don't do during the process. It is critical that you understand that if you follow these rules, you will be safe and you don't have any headaches. Number 4, do not spend money you have set aside for closing. Number 5, do not omit debts or liabilities from your loan application. Number 6, do not buy furniture while you're in the loan process. Any debts that you purchase, like the car, like furniture, and so forth, any additional liabilities, we will find out, because most lenders, most banks usually run a soft pull to see whether or not there's been any debts added right before closing. So this could, prohibit you from closing. It could interrupt your qualifications. So word to the wise, it's not worth it. Stay the course and get your house. Number 7, do not originate any inquiries on your credit card. You will have to explain them, and we'll have to look into it. Number 8, do not make large deposits without first checking with your loan officer. Every large deposit in excess of $500 has to be explained. It has to be explained thoroughly with the backup documentation. So you can't just say, oh, my brother gave me the $500 he owed me. That's a lot of paper trail. And if you can't do a paper trail, you can't use the money. Number 9, do not change bank accounts or move money between accounts. And number 10, do not co-sign a loan for anyone. Okay, that is just absolutely critical that you don't do that, because that could prohibit you from qualifying. Uh, Co-signing is a big deal, and the way the bank looks at it, any bank, any lender, if the person that you're co-signing for can't pay for it, you have to. So they're going to count the whole debt against you. Um, Now I'd like to cover the grant uh, program. And I am going to talk to you. Let's see, let me just get to the specific slide. So, grant funds are funds that you qualify for to assist you with down payment assistance, either down payment or closing costs. They can be used for either or. However, However, you have to qualify for the grant funds. So you could qualify for a mortgage with us or with any other lender and not qualify for the grant funds, because a lot of these grant funds have a debt stop qualification on their debt to income ratio. Okay, for instance, the MMP, which is the Maryland Mortgage Program, First Time Advantage, offers you 3, 4, or 5% in down payment assistance. Um, it's eligible for first-time home buyers, offers a low interest rate, but the rate is usually about 3/4 of a point to 1 point higher than the rate that we would give you without a grant program. So with a grant program, you have to use their rate, okay? If funds exceed down payment and closing costs, then the remainder can be applied to the principal. The second loan is paid off when the loan is refinanced or sold at zero interest rate. Eligible borrowers must qualify for an MMP loan, that's Maryland Mortgage Program loan. Example, income limitations. It's income, in other words, it's income driven, and you have to income qualify. You have to have the credit score, typically it's 640 to qualify, and you have to purchase within their purchase price limits, and that we'll have to look up every on the particular program that you're looking at. Keep in mind that MMP offers some great programs in the state of Maryland, and at 3, 4, and 5%, they're awesome. However, there's a dead stop at a 45% debt ratio. There's a dead stop at your FICO score. So if you're not qualified for their program, we'll tell you up front, you could probably still get a loan with us, but then you'll need to have your own money in order to do that. You won't be able to do that with this particular program. Then there's the MMP, the Maryland Mortgage Program, First Time Advantage, 6,000. Again, eligible for first-time home buyers, offers a low interest rate on the first mortgage and a deferred no interest second equal to $6,000. If funds exceed down payment and closing costs, then the remainder can be applied to the principal. The second loan is paid off when the loan is refinanced or sold at zero interest. Eligible borrowers again must qualify with on an MMP loan, income limitations, credit score, and purchase price limits. The Home Start 6% down payment assistance program is pretty much the same thing. But all of these programs have little criteria differences. So, but they all mean the same thing. And the bottom line is you'll get down payment assistance. The Smart Buy is required is a student loan that will be a 5-year forgivable second loan. The borrower can apply for a CDA $6,000 loan or down payment equal to the 4% of the first mortgage or 6% under 50% of the area median income can be used toward down payment. So in other words, it's a little bit more in depth. The minimum credit score for this is 720, okay? So the ante has gone up, and it's very difficult in some cases for people that are first-time home buyers to look at something like this unless you have excellent credit and meet the income guideline. Then there's Washington, D.C. and the D.C. Open Doors. That's a zero down payment, up to 100% financing, no first-time home buyer requirement. Maximum DTI is 50, FHA is 45, unless your credit score exceeds 680. Loan amounts up to about 647, 200. Maximum borrower income limit is 154, 800. One thing I neglected to mention: any income in the household for any of these programs have to be counted in the qualification. So it's not just one person applying. It might be just one person applying, but if you have a son or daughter that's working, if you have a spouse that's working, we need to count their income even if they're not on the loan. Then there's the first time home buyers federal home loan bank grant funds. And they will give you, this slide is incorrect, it should have been updated, to $12,000 assistance in closing costs. And you have to contribute at least $1,000 of your own money into the program. Now, this is also good for community partners, current or retired law enforcement officers, firefighters, employers of state accredited schools, employees of healthcare systems, first responders, active duty military, veterans, surviving spouse, and COVID-related essential workers. When it was, now they offer 15,000, not 10,000. But again, this is a 45. We have to look at the qualifications as far as the debt to income and the income. Your income is a qualifying factor on this as well. And then there's VHDA, maximum grant of 2.5%, and this is for Virginia loans. Minimum credit score 620, maximum DTI 45%. Grant funds have no repayment, can be paired with MMC certificate. It's a tax situation. But requirements: eligible for first-time home buyers. Grant funds must be used with eligible VA housing loan income and sales price limits. So that's it for this evening, and that's it for the grant programs that we have to go over right now. I'm really privileged and honored that you joined us this evening, and look forward to seeing you next Tuesday when we will discuss, again, Sean Higgins will discuss credit scores and everything to know you need to know about your credit FICO score. And I will discuss Mortgage 101 next Tuesday evening at 7 o'clock. Thank you for joining us. Thank you, Sean. You've been amazing as usual. And thank you, folks, for allowing us in your homes.